connect with Sandeep Tandon, management of Syrma SGX. They came out with an issue and the anchor lock-in is over. The executive chairman, Sandeep Tandon, joins us now. Sandeep, good morning. Thank you for joining us. PLI schemes have boosted the manufacturing export production from 1% in 2016 to 22% in 2023. Are you seeing more export inquiries coming to your company because of the China Plus One?
Yeah, so just to give you a background, we as a DNA have been export-led. So my father had built a business which made the first floppy drive for the first IBM PC out of India. So that story is not very well known. So we are very export-focused. So we always knew how to take care of these customers, right? The export customers to meet all their requirements, to have the stringent quality of manufacturing as well as the extreme price sensitivity that they have. So I always believe that the global market is huge, 500 billion. But unfortunately, India lost a plot in 2000 when China just went aggressive and brought all these customers to China, opened the Chinese market as well to them. So India lost the plot. But now with the PLI scheme, which is focused on making it a level playing field for us to manufacture, and our domestic demand picking up, there is no option for all the customers, global brands, to look at India as the option for manufacturing. So that has changed, and that is driving the most interest. And since we are across sectors, specifically in the industrial segment, we are seeing a huge demand for export for the China Plus One, because they want a resilient supply chain that is not dependent only on China. So that's where India plays a huge role, because they already are used to doing their design services out of India. So when they work with us, they get a strong partner that can take care of their design as well as their manufacturing needs. So I really think PLI is just the icing on the cake or the cherry on top, but everything else has already been with COVID, the situation for China playing as a weak link in the supply chain, and the geopolitical situation also. Those things and has created like this perfect storm. So I like to call this India's Y2K moment, what was for the software services, equivalent to that for the manufacturing services.
Like you mentioned that you are more export story, but the near term, are there any concerns because of slowdown, what is happening in Europe and in US?
So definitely demand is sluggish for the next 2 quarters from European markets, more so than American markets. American markets are much more resilient. European market, it's more uncertainty, not yet consumer or industrial demand. It's more uncertainty on the energy, right? So they have factories that have to run in the deep of winter. They're not sure if they're worthwhile to run. So they're being very cautious on building up inventory. So definitely next 2 quarters on the European side, we are seeing sluggishness. But long term, right, like I was telling you, right, this is a shift that is happening. So because we are qualified, there's a shift that is happening. It's not a growth. We don't need a global growth. There's a shift from one factory to another. And when that shift happens, when the scale is a 500 billion opportunity, it's still growth for a small company like ours.
Okay, so as we talk about growth, let's also talk about the margins, right? You had guided for a double.
If I may come in then, and Mr. Tandon, just understand what the outlook is in terms of your margins, because you did guide for a double-digit margin for FY23. In Q2, your margins were at about 10%. So is this going to be the base, or is there more upside?
So what happens in our industry, right? We have to be very, very lean so that our customers can be winners in their markets. So I always believe what like Jeff Bezos says, right? My competitor's margin is my opportunity. So the scale is so big, even if we keep our focus on double-digit margins and give the rest to our customers, we will win. So that's the way I think. And if you think about it, you really have to, the scale is so high, you should not only think in percentages, you think in absolutes, and the absolutes are amazing. See, we do a lot of work with our customers. So we start from, grade zero, where we help them design, we help them source the materials, and we help them manufacture, we help the supply chain. So entire cycle is with us. So when we do those things, right, automatically the customer is okay with us adding more value to their systems. So our whole opportunity and drive will be to stay double digit. Of course, keep pushing higher is always possible, but we want to win more business also, and we want to drive more growth. So between growth and margin, we are very, very cognizant, and we want to win and grow, and that's how I look at it.
And now 27% of your revenues come from ODMs, which are high margin services. So what's the kind of differential margins that you witnessed in ODMs and contract manufacturing, and the mix that you're targeting now over the next 5 years or so?
So see, the growth on ODM is slow because it takes time for product market to get into the mix. So it is, like I was saying, it's harder to expand the ODM business as fast. But of course, when you add one business, the ODM opportunities also emerge automatically. So it'll always be a mix, and there won't be a catch up. So maybe 12 to 18 months around, you'll see big spikes in our ODM revenues also. But these are longer cycles, so you can never match a cycle, and I cannot predict, okay, this is going to happen, that is going to happen. But definitely ODM is a core focus for us. And as far as margin profile, there's similar margins. It's just you add more value to it, right? So effectively, you have much more control of the supply chain and the way you service that customer. So that's why I think ODM and manufacturing together, we will continue to be, very strong on our margins from industry perspectives. But of course, I want our customers to win.
Now, the company's also commenced additional production lines in Manesar. I'm just going through what all has been announced. 2 new SMT lines that's going to be in the first half of FY23. Your plans to commission another 3 by the end of the financial year. Once all of this goes live, what is it going to mean for your P&L?
No, so you can expect us to continue to meeting industry growth, which is happening in India. So we are expecting to continue at 40% growth. Of course, we are aiming for more, but as far as that, I think we have a pipe, as well as the interest, as well as our, most of our IPO was on OFS to build for this expansion. I really see this opportunity being very big for India as well as for our company, actually more for our company because of our background and being able to serve these kind of customers. So definitely you can continue seeing industry level growth from us.
Let's talk about your order book. What's it looking like?
Order book continues to be strong. Like I told you on the guidance side, we have an order book that is showing more than what we need to do. So definitely very strong as of now.
The company has received PLI licenses under various schemes. Can you share any update in terms of the status of CapEx for some of these segments?
We have PLIs in two sectors already. That is the telecom sector and the white good sector. So those 2 sectors are there. In the PLI for telecom, we had already made the capex and started production last quarter, and that is taking off, and we are very confident of getting positive in PLI in the telecom sector right away. White goods sector, we are still little delayed. It should probably by Q4 this year or Q1 next year, we'll start production on the white goods sector of our PLI schemes. In addition, we have one more PLI that we've applied for that'll be in the IT sector.
All right, we'll let you go on that note. Thanks very much for sharing with us your thoughts.